Hello and welcome everybody to Hurdle Rate. Today we're going to be going through a discounted cash flow analysis of the luxury behemoth LVMH. Before we get started, please remember that this is by no means financial advice and please do your own research before making investment decisions. And also, I must disclose that I do have a minuscule amount invested in this company and that's to be fully transparent. So now that the admin and disclaimers are out of the way, without further ado, let's get going. LVMH needs very little introduction and is colloquially known as the House of Brands, being the umbrella company for so many famous and iconic luxury companies such as Bulgari, Louis Vuitton, Veuve Clicquot, Tiffany, Sephora, Loro Piana, Dior, Givenchy, and many, many more. So, what do we hope to achieve through this analysis? We are going to try and identify the intrinsic value of LVMH using a DCF model to see if there is any upside potential in the stock price or become wary of any possible red flags that would deter an investment. We will use the free cash flow to firm method, which tells us the cash flow generated by the company that can be provided to all capital providers. And just to note, I will make this Excel file available to download afterwards so that you can simulate your own forecasts. The order of play will be: first, we will look at the current state of play, look at the price history over the last 5 years of LVMH, compare that with its peers of Hermes, Richemont, and Kering. Then we will look into the core of the company, analyzing the revenue drivers, breaking them down by both product segment and region, and then we'll look into the margin performance. And afterwards, we will build a WACC to forecast the risk to those future cash flows. This will give us an implied share price where we can simulate different scenarios using base, bear, and bull case figures. And once we have this, we will conclude with a few comments on the bullish and bearish scenarios and how they could play out. So today, LVMH is trading at about 498 euros per share, almost revisiting where its share price was at the end of 2020 before it had that monstrous surge. The post-pandemic boom saw the price hit a peak of 900 euros before tracing back down to below 500 euros today. LVMH currently has a PE ratio of 22.87 and is trading at 2.97 times sales, with its EV to EBITDA ratio being 14.78. Now, let's bring in the peer companies to give those numbers some context. Comparing LVMH with its contemporaries, Hermes, Richemont, and Kering, we can see that the top three pretty much moved in tandem with each other up until mid-2023 when they started to diverge. This was down to changing economic conditions with easy money tightening and LVMH having a large swathe of its clientele being more in the aspirational luxury segment where they are significantly more price sensitive to interest rate increases. Hermes, on the other hand, targets the ultra high net worth individuals who are price inelastic and provide demand for all seasons. The confidence in the company's performance was further highlighted when it briefly overtook LVMH's market cap earlier this year, despite LVMH having more than 4 times its revenue. We can see by all three average price ratios, LVMH is trading at multiples significantly lower, meaning it could have room to run if we based price forecast on those indicators alone. We must acknowledge, though, that Hermes' multiples are sky high, therefore skewing the averages. Now let's dive into the DCF. So starting at the top of the income statement, let's look at revenues by product segment. The first category is wines and spirits and includes illustrious names such as Veuve Clicquot and Hennessy. Then we have perfumes and cosmetics like Givenchy and Dior, watches and jewelry, selective retailing such as Sephora, and the largest product segment by far, fashion and leather goods. To note, there is also another category called other activities and eliminations, but it is less than 1% of revenue, so we will keep it as that going forward. So 2025 revenue is forecast to be 83.57 billion euros, which is a 1% drop from the previous year, and since 2019, the CAGR for revenue has been about 8%. One thing to note is that alcohol is struggling in line with global trends, and we've seen that in other companies such as Diageo and Anheuser-Busch. We know that watches are struggling too, and that has been offset by strong performance in jewelry. Fashion is the key driver of revenue, but it is starting to head south, and Sephora is performing well, driven by strong sales in makeup and skincare, and perfume has remained resilient amidst the downturn. We can see that LVMH has multiple product segments, so not solely reliant on one area. It is possible that it could be kind of used as a luxury ETF with so many different revenue streams. Now looking at revenues by region, we can see there is a slight decline in both US and European markets, where both represent about 25% of revenue each. The largest drop comes from Asia, where in the previous years, a weakening Japanese yen led to a surge in tourism to Japan and sales boomed. This favorable currency tailwind was not there for the following year, hence such a large decline in Asia revenues. You would have thought that maybe the Middle East sales could have offset this decline, but no. The region Other includes developed markets such as Australia and Canada, along with Africa and Latin America. They both showed strong growth, but not enough to offset weakening in established markets. Okay, now double clicking into regional revenues, we can break down the average revenue per store. LVMH has more than 6,300 stores globally, a slight increase from last year, and each store has an average revenue of about 13.21 billion euros per year. Europe and Asia are mostly flat, with Japan being the anomaly due to unfavorable currency movements. The US stores are the highest, generating on average nearly 18 million per year, which is lower than 2024 but still considerably higher than other markets. Other is growing healthily, showing nearly a 3% increase from the previous year. Now that we have a good picture and understanding of how LVMH generates its revenue, let's move on to the EBIT. The operating margin tells us how healthy the company is and is a key component of the valuation. We can see from the chart that EBIT is trending south for the higher margin product segments. Perfume and selective retailing, which comprises of many products that are regular repeat purchases, are holding but tend to be lower margin by nature. The overall EBIT margin is around 21%, when historically this number has been closer to 30%. The company will generate around 17.6 billion euros in operating income for 2025, and this is considerably down from previous years such as 2022 and 23, when that number was over 20 billion euros. This will have a huge impact on free cash flow. We can see that alcohol seems to be in free fall, but encouragingly, watches and jewelry are showing signs of a recovery. Fashion is still high margin, but if they want to rival Hermes's operating margin of 40% plus, then a strategy shift is required to manufacture scarcity and make the products more exclusive. Perfumes and selective retailing are holding nicely, but these segments will never be high margin because of their nature as regular purchases. Now we have an understanding of the margin. Let's build the discount rate so that we can forecast free cash flow. So the first component of the WACC that we will build is the cost of equity. The cost of equity is the required rate of return for shareholders to invest in the equity instead of the risk-free rate. We will use the French 10-year government bond as the risk-free rate, which is 3.463%. The beta will be 0.75, and that is comprised of betas from different industries where LVMH operates, weighted to LVMH's proportions. The equity risk premium is 5.87%, and this represents a blended figure of risk premiums from different regions where LVMH generates its revenues. So the cost of equity is the risk-free rate plus the beta multiplied by the equity risk premium, which gives us a cost of equity of 7.87%. Now that we have a cost of equity, this leads us directly into the WACC. The WACC is the average rate a company must pay to finance its assets, weighted by the proportion of debt and equity in its capital structure. It is calculated using the following formula: the percentage of equity multiplied by the cost of equity plus percentage of debt times the cost of debt times 1 minus the tax rate. Using these inputs, we get a WACC of 7.22%. This figure will be used as a discount rate to calculate the present value of future cash flows. Now back to our DCF model. We take our EBIT and we subtract the taxes paid to get the EBIT, which is the earnings before interest but after tax. If we anticipate a bit of margin recovery over the next couple of years, EBIT will settle at about 14.3 billion euros. We take these EBIT forecasts and add back in depreciation and amortization because it is a non-cash expense. We'll subtract capex and then subtract change in net working capital, which gives us the unlevered free cash flow for the next 5 years. A quick note that capex is higher than depreciation and amortization, showing they are investing in growth, and due to favorable terms in their supply chain, change in net working capital is negative, which is a boost for free cash flow. Now, using our WACC of 7.22%, we need to discount the unlevered free cash flow back to the present value. This is done using the formula at the bottom of the page. PV is equal to the unlevered free cash flow divided by 1 plus the WACC to the power of number of years. Now remember that the final number in 2030 for unlevered free cash flow, as we will need that in the next step for the terminal value. We are in the final steps of the valuation process now. To get the terminal value, we take that 15.5 billion euro figure from the unlevered free cash flow in 2030 and multiply it by 1 plus the WACC, then divide by the WACC minus the terminal growth value, which I've put at the bottom of the screen as 2.5%, which is a standard rate to use for mature companies such as LVMH. This calculation gives a terminal value of 352.2 billion euros. The present value of this being 248.5 billion euros, we use the same method as before by applying the discount rate to the terminal value figure. We then find the enterprise value by adding the present value of the terminal value to the total amount of the present value of free cash flows forecasted. This gives us an enterprise value of 312 billion euros. We then add back the cash of 12.3 billion and subtract the total debt of 39.7 billion, giving us our equity value of 285 billion. This, when divided by the diluted share count, gives us an implied share price of 571 euros per share, signaling a potential upside of 17% for the stock. The 571 euro price target was a base case forecast. We can run both a bear and bull case scenario to see what our range could be. Firstly, for the bear case, we have a WACC of 7.72% and a terminal growth value of 2%. Growth and margin rates have been set at 95% of the original figure. This gives us a price of 447 euros, indicating an 8.5% downside. This figure is actually close to where the price bottomed out earlier this year. As for the bullish scenario, we use a lower WACC of 6.72% and a more aggressive terminal growth value of 3%. This time, growth and margin rates are 105% of the base case figures. Plugging these in, we get a price of 760 euros, which would be 55.72% higher than current prices. Considering previous highs of 900 euros a share, this is not unfeasible. LVMH, I would say, has more potential for upside than downside. But before we close out, here are a few final thoughts. A worry is that 1/3 of assets are goodwill or intangible. This is not great as a large part of the value is tied up in the brands remaining popular. This is a necessary evil for luxury companies where the value lies in the name. With the dividend covered by 1.67 times earnings, is this safe with margins if they keep getting compressed? Usually we like a coverage ratio of about 2 times net income. By scaling beyond the super rich, LVMH opened itself to economic headwinds by catering for price-sensitive clientele, and whilst this has increased revenue, it has made sales more volatile each year. As mentioned before, generational shifts in alcohol consumption sees it hard to forecast a recovery in that sector anytime soon. And lastly, the market has been consistently worried about Bernard Arnault's plans for succession considering his age. It is impossible to imagine the company without him, which is a huge worry. Going forward, LVMH will probably return its focusing to catering to more price inelastic consumers like Hermes does. This will strengthen their margin and generate more predictable cash flows. We would like to see a divestment of lower margin assets before further acquisitions. There have been rumors that portfolio brand Marc Jacobs will be sold, but nothing concrete yet. Ideally, we do not want to see acquisitions through share price dilution and the balance sheet having even more goodwill on it. I imagine the strategy for the stake in FlexJet is to further enhance its luxury travel portfolio with the Belmond and Bulgari hotels. Lastly, with tariff uncertainty, reshoring the supply chain back to regions such as Europe could push the sentiment back up to LVMH being even more luxurious and exclusive. Well, that's enough from me today. I hope you found this deep dive useful, and I look forward to seeing you on the next one.